Okay, so good morning, everyone. Welcome to the Macro Snapshot. What are we? Wednesday, November the 19th, 2025, recording this in the morning. Okay, so we have two main events today, which the market will probably be most focused on. At 2 p.m., we get the FOMC minutes for the last meeting from October. And let's just look at the probabilities. We can see now that the chances of doing nothing of the Fed not cutting at all in December are now about 51%. And we can see that the chances of cutting 25 basis points are at 48.7%. So essentially 50-50. If we just have a look and see historically how that's compared, we can see yesterday it's come down a little bit. And certainly from a month ago, we've come down from approximately 95% probability of a cut. So the point is that the market, as we all know, has repriced in a sort of hawkish way. And that's because after that last meeting, excuse me, I have some birds in the background. That's because after the last meeting, Powell basically came out and said that there was, strongly differing views, quote, strongly differing views on the FOMC committee. We know that someone like Schmidt actually dissented and did not want a cut at all at the last meeting. And we also know that Trump's appointee, Miran, basically wanted a 50 basis point cut. And since that meeting, we've seen a variety of Fed speakers going from the neutral and data dependent to the slightly more hawkish, worried about inflation, to those worried about sort of the employment market and potential to hit growth, people like Waller and Miran. And keep in mind that Waller is in the running potentially to become the next chair of the Fed. By the way, Besant said that Trump would announce the next Fed chair sometime before Christmas, so I guess in the next 3 or 4 weeks. So is this going to be market moving? I'm not sure because it's quite old news, and we know that there is quite a lot of dissension amongst the Fed. But nonetheless, if the minutes today reiterate the chance that there's an absolute possibility that maybe even a small majority of members are worried about a December cut, for sure that could put some downward pressure on equities and on the front end of the curve. So we'll see. We also have today, we have a few Fed speakers who might give us a bit more detail. We have Williams, Logan, Barkin, and Miran. Miran, of course, is going to be very dovish. Always interesting to listen to Williams. So let's see what's happening there. Other thing to keep an eye on is, of course, NVIDIA. So let's just look at NVIDIA chart here. And we all know that there's been a lot of, let's just bring this up here before I start saying anything. Okay, so you can see that NVIDIA, just on the daily chart here, we know it's had a huge run up and it's now at a pretty key levels. Key levels are probably about the 177.20. So what's the market going to be looking for? The market, of course, wants to know about the shipments of the Blackwell and the Rubin sort of chips. What are the orders going to be? There's expected to be an EPS of about $1.24, the earnings per share. Revenue expected to be about $54.5 billion. The market will want to be focused on the situation in China. We know that NVIDIA, because of the lack of exports or the export bans to China on their most high-tech, the H20 chips, they're essentially leaving billions of dollars on the table. So the market wants to know if there's any sense that there's been any movement there. And also the margin's going to be important. Is it going to be around 70% margin? How are they doing? So all of these metrics are going to be important. We know that NVIDIA is a great company. They're selling a lot of chips, $500 billion in order apparently, but they want to see whether the pipeline is looking good and especially whether the production capacities are able to fulfill the orders. So there seems to be a bit of a lag at the moment between the production capacity and the orders which are on the book. So the market wants to know that they are ramping up their production capacity and also that the margin is still as high as expected. Okay, in terms of what the option market is telling us, kind of interesting that we've got an option market about 7.75%. So if we look at the pre-market here, and again, that was the option pricing from the end of yesterday. So if you look at what the option market is pricing for the straddle, we're looking at it, something like about that. So you're looking at about a $14 swing to the upside. So anything up to, let's say, 198, technically 198.5. That's what the option market is pricing. And that's an interesting level up there. Let's call it 199, almost like $200. So on the downside, what you're looking at, again, going for the option market pricing, what's expected is about 7.75%. So you're looking at something around, again, about $14 either side, $14.5 either side. So about a $30 swing overall. And on the downside, you're looking at this level of about $170. So about 170 up to approximately 200 is what the option market is pricing in as a potential range in terms of those buying straddles and whatnot. So that's where we're at, and of course that's going to give a future sort of direction for the market if the market likes that. No reason to expect that the Nasdaq, for example, can't have a bit of a push. As you can see here, Nasdaq at an interesting level, quite a lot of support here at about the 24,300 mark. So if Nvidia obviously is a beat, for sure, that could have a bit of an upside pop. On the other hand, we are just falling below this sort of channel here. And if I actually go into, let's just put on some, so I'm just going to put on some moving averages here. So just the ones I like, the 20, the 50, 100, and 200. You can see here that it's a pretty key level here because we have the 100-day EMA just here, which we bounced from, which is also this horizontal support. So key levels here. On the other hand, if Nvidia disappoints, and let's say the FOMC minutes do come in a little bit more hawkish than expected, and really show that maybe even a majority of committee members, even if they cut back in October, are very wary about cutting in December. For sure, we could see on a double whammy of weak Nvidia as well, or weaker than expected Nvidia earnings, we could see the Nasdaq pushing down below, breaking this key level. And who knows, the next support looks like it's down about here, which is the 23,300. You can see there that that's a pretty key level. And in fact, it's such a key level that it merits a little box, a little Nick box. If you're listening, Nick, it's a little Nick box there, which also coincides with the 200-day exponential moving average. So a pretty key level there, and that would essentially give us something like about a 4 or 5% move, which is significant. But keep in mind that so far from the top, we're only down, about 6 or 7% here. So if we want to have a full correction down to 10 or 12%, that's definitely a move. I mean, I anticipate that things would be brought up there. And again, I'm not saying that will happen. It would require a sort of a confluence of factors. So obviously weaker than expected Nvidia earnings, as I say, a very, very hawkish, much hawkish than expected minutes from the FOMC meeting. And that's that. And also possibly some hawkish data. Now, in terms of the data, what we're getting, I just want to cross off a couple of things here. So in terms of the data, we did have yesterday, we're starting to get partial data coming out. So the problem is that this is going to be released in a very piecemeal fashion, a bit at a time, a bit here, a bit there. And so, for example, something like the commitment of traders reports, I was looking yesterday, we're not going to get a full update of that until January the 23rd. It's going to take all of that time to do a catch up, about 2 months. So the point is that the data is going to be released in as I say, a slightly piecemeal fashion over the next few weeks. But I guess, the market will start looking at it. What we did get yesterday is what the ADP, which is the private payrolls, their 4-week sort of moving average, what they're calling their employment report pulse. Again, it was a little bit negative. Again, it's just kind of a moving average, so we can't take any, definitive data away from this. But nonetheless, it was negative 2,500 jobs loss, according to this metric. And again, without sort of overly focusing on this, it does seem as though the labor market is showing some signs of weakness. And of course, tomorrow we are going to get the September NFP numbers. Now, of course, September, that's old data. It's just going to be sort of asymmetric in the sense that if it's slightly if it's a beat stronger than expected, maybe the market will say, hey, that's old news, that's before the shutdown, it's irrelevant. On the other hand, if the data is weaker than expected, could this just contribute to a sort of a negative sentiment, and be added to things like this ADP number, and say, oh, things are getting a bit weaker, and therefore it could start to sort of, build the sentiment that the real economy is actually falling. The other thing, of course, is we got the initial jobless claims yesterday. It was for the week ending October the 18th, the week of October the 18th. So again, old data that came in at about 223,000, which is still signaling a robust employment data. But basically, apparently tomorrow, which is November the 20th, we're being told that we'll get the full data series of initial jobless claims. So that, I think, is actually going to give the market a lot more sort of precision, shall we say, on the employment data. So let's say, for example, if we get all of the initial jobless claims showing a constant weakening, that could get the market's attention. But again, we're going to have to wait and see until tomorrow's data. Okay. So let's look at some specific sort of charts and just see what's going on. Overnight, there's been a lot of talk about Japan. So let's just focus on Japan for a little bit. I just want to first of all bring up the the yields here. So if we look at the Japanese 30-year yield, and basically the reason I'm bringing this up is because the new administration over in Japan under Prime Minister Takeichi, you can see here, look at the Japanese 30-year yields. This is really outstripping the movement, at least in things like the US and even like the British bond up there. Just this whole push towards long end bonds going a lot higher. And as you can see here, if you look at the yield now, over at about 3.34%. Remember the days when Japanese yields were at zero. So now we have 3.34%. And obviously this year, this has gone up a lot, like 100 or 200 basis points. And it's now threatening to break out to even new highs. And what's kind of interesting is that from a sort of a global perspective, is that I mean, historically, and when I say historically, I mean, let's say the last, 5, 10, 15 years, Japanese investors have found it very difficult to get good returns at home. So they have expatriated, exported a lot of cash, basically piling into, let's say, US treasuries, German treasuries, Italian treasuries, other investments, US stock market, to try and get a decent pickup of yield. But the point is, and that's kept the Japanese yen historically or structurally kind of weak. And also the Japanese yen, because of that, has been used for the carry trade. But let's imagine a situation where we have these 30-year yields in Japan now giving a decent pickup in yield. So we now get 3.5%. So it's a decent yield income. And remember that if that's because it's back home, you don't have to hedge for currency. And remember that when front end rates were quite high, Japanese investors, for example, or non-US investors, they would have to hedge their returns, their FX returns, and that hedging cost would cost them quite a lot because essentially it's the cost of front end yield, so maybe 2 or 3% or so. So the point is that what I'm trying to say is that with Japanese yields now in the 3.5% for the 30-year, that is a decent income. And we could start seeing some repatriation, some onshoring of sort of assets back into Japan. People basically saying, hey, why do we need to have German bonds or US bonds anymore, or even the US stock market? We're getting a good pickup of this. So let's get out of those holdings and bring the money back on shore. And when I say the money, I mean the Japanese yen, because this is an unhedged a return of 3.35% here. So that could be some structural strength for the Japanese yen, which also, of course, could mean that the carry trade becomes less attractive as a funding currency. I mean, that could provide a bit more volatility. So it's going to be an interesting thing. Again, I'm not saying this is something which is happening today. But it is interesting just to see what's going on because the Japanese bond market is huge. Other thing which I just want to quickly point out, if we look at gold, I was just putting gold against the 30-year yield here. If we go back, let's say, like a year or two or so, we can see that gold in the blue here. I'll just get rid of the hold on, let me get rid of the moving averages just to make that cleaner. So you can see, oops, got rid of everything. So let's put gold back up. Sorry about this. Okay. So if we look at gold, we can see that gold, I don't want to overread into this, but you see that gold is very, very correlated or seems to be fairly correlated with the Japanese 30-year yield. I mean, it's correlated with other things as well. But is this saying, this is interesting to me because is this gold push, we all know that gold has had a huge run up over the last, 6, 12, 18 months or so. Is this really maybe less of an inflation story? Well, it's kind of combined with inflation, but really a sort of a fiscal responsibility story. And this idea that, for example, the UK is issuing too many bonds, the Europeans in general are issuing too many bonds, the Americans are issuing too many bonds. And now with Japan, we have the new administration, Takeichi, with a huge stimulus a package being planned. What was the number? I think I forget the number, but it was many, many trillions of yen. So a huge new or a substantial new stimulus package being released, which will necessitate even more issuance of long-term bonds in Japan. So globally, we have a lack of fiscal prudence, a lack of fiscal discipline by governments, and that's and basically spending too much, pushing up deficits. And just interesting, really, to watch how gold is correlated with something like the 30-year yield in Japan. You could see when the yields came down, gold's down, the yield going up, the gold going up as well. So that's definitely, I think, one of the sort of the structural reasons for gold's sort of climb is just this lack of fiscal discipline. So let's keep very focused. Obviously, we have things like the UK budget coming up on the 26th of November, which is actually a week from today. That's going to be very important. And it's also a way of trading that could be to look at the gold market as well as the individual bonds. But just getting back to Japan, What's interesting overnight, just getting back to the yen is weak at the moment because the dollar is strong. But and what I was just trying to say, it's much more of a structural move. Maybe it's a 2026 story. But if we actually look at the Japanese yen, if we look at the USD JPY, you can see that it's broken out. I was talking to someone yesterday, Danilo, if you're watching this, keep an eye on this. You see here how the US dollar is breaking high. It's broken this downtrend. It's breaking out of this topwards channel. And if you look again, just to keep an eye on something like, again, this the moving averages, you can see here that this is, a strong uptrend in the 20-day moving average, really accelerating away from the 50-day moving average. And you've got to say, not saying it's going to go parabolic and get up to the 158 or 159 level, which would be this, but before we have intervention, I think there's more room to go. And one of the reasons as well, apart from the higher yields in the Japanese 30-year bonds and the 10-year bonds, and one of the reasons for this strong breakout in the USD here is that there was a big meeting between the Minister of Finance over in Japan, Mr. Katayama, and Ueda, who of course is the governor of the Bank of Japan. And sort of the money quote which came out of that meeting was that no specific discussions of the FX level with Ueda. And the market has interpreted that as meaning, we're less close, so we're not as close to interventions by the Ministry of Finance or the Bank of Japan. And that's maybe just why here the US dollar's gone up. So just be careful, those of you who are thinking about shorting, based on interventions. I personally think that we have a little bit more to go. And as I say, the Japanese authorities seem to be more excited these days intervening on the back of US dollar weakness. So what could cause that weakness? It could be the non-farm payrolls number, which we're getting. Are we getting that tomorrow? Yeah, we're getting the non-farm payrolls number for September. If that comes in weak, that could cause a bit of short-term US dollar weakness. But at the moment, I don't think there's going to be any sort of discrete how could I say, unilateral is the word, a unilateral intervention by the Ministry of Finance over in Japan. Other interesting currencies to keep an eye on is the pound. As I just mentioned, there's the all-important sort of budget being released next week. But we got overnight from the UK. There was slightly higher than expected inflation, especially food inflation was higher than expected. Does this mean that the BOE won't be cutting in December? As you can see here, the British pound had a little bit of a pop, just a little bit of a pop against the US dollar, but it's given its back because the reality is that probably this won't be enough to derail a cut. And it does seem as though the governor of the Bank of England, Bailey, who has the majority vote there, the tying vote on the Monetary Policy Committee, it does seem from his comments that he believes that there would have to be a significant upward revision in inflation in order for the BOE not to cut in December. And that's just why the British pound here just rolling over here a little bit and finding it difficult to sustain any upward meeting. And also the fact that we do have the budget in the UK next Wednesday, it's going to be hard for any, as I said, sustained upward movement here just over the next week because the market is pretty nervous about that budget. Okay, other things to keep an eye out in with China. We have tonight the what do they call it? The LPR, the loan prime rate, which is essentially the key interest rate there, one of the key interest rates in China. It's expected to remain unchanged. Let's just see if it's cut. That would be a surprise. I don't think it's going to happen, but there's just something to keep an eye out for. Other things as well is just in terms of the earnings. We had Home Depot yesterday, or Home Depot. If we look just at the ES here, we can see it again bounced off the ES futures here, bounced off the 100-day EMA. But basically Home Depot yesterday, the earnings were the performance was a bit weaker than expected, and basically management was fairly downbeat in terms of sort of home renovations. Apparently consumers are nervous; they're not spending on big ticket items. The cost of interest is too high, so Home Depot was lower than expected. And of course, we also have Lowe's coming out with earnings and Target. So Lowe's and Target, let's keep it on out. Those they'll be released today. So Lowe's and Target, just in terms of the average US consumer, how are they feeling? What's happening? We're going to have Walmart later on in the week, but we have Lowe's and Target today, apart from Nvidia, and that's going to be just interesting in terms of sentiment for the US consumer. So putting it all together, the question is, can the stocks have a bounce? What would require a bounce? Would probably be And as expected, FOMC minutes, relatively good employment data coming from NFP, maybe the initial jobless claims numbers tomorrow. Maybe we get, slightly better than expected earnings from Lowe's and Target, and maybe Nvidia is positive. If we put all that stuff together, there could be a bit of a boost overall for the stocks, and maybe, this 5 or 6% sell-off we've had will be enough. Let's see what happens though. Apart from other markets, I think I'll just leave it there, guys. That's probably enough for today. As I say, it's going to depend on earnings, the FOMC, and obviously Nvidia today. Let's see how we go with all of that, and that'll probably give the market the direction for the next 24 to 36 hours, which of course, the next big thing is going to be the non-farm payrolls tomorrow morning released for September, even though, as I said, I think that's a little bit asymmetric. Thanks very much. Have a great trading day, and we'll be back tomorrow. Goodbye.